Welcome to the Market Edge Tech Talk with Will Pauly and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tuesday Tech Talk for Tuesday, December 17th, 2019. My name is Will Pauly and I'm here with my co-host, David Blake. David, how are you doing today?
Good, Will. Thanks for asking.
All right, David, let's start off with a look at where the market's been doing, what the market's been doing this past week with a look at the market letter. Can you give us a quick explanation of what we're seeing here?
Yeah. Okay, we're starting last week. I want to apologize for not having a couple tech talks here the last couple of weeks. I was traveling out of town, so we'll try to get back onto it here. But last week, investors were a little bit cautious as we started out the week. We had a slew of meetings with the FOMC meeting that got underway Tuesday and finished up on Wednesday. And we also were waiting on what was going to happen with the Phase 1 Chinese trade deal. Well, we broke out of the doldrums a little bit on Wednesday after the FOMC meeting concluded. They left rates unchanged as we figured. But then Fed Chair Jerome Powell also came out with some pretty dovish comments. He cited that inflation was running below 2%. We had a good jobs market, rising economic activity, but they didn't see any rise in rates going out probably through 2020. Now that's subject to change, of course, but that probably kept maybe some of the more defensive sectors like the utilities and REITs from selling off. In fact, you're having a little bit of a bounce the last 2 days in utilities, which is a little bit surprising, but that's good. Then we had, on that news, yields nudged a little bit higher since they figured we weren't going to be moving, going down anymore probably. We had the U.S. dollar moved a little bit lower. That gave a boost to commodities. And then with the trade deal on Friday, we got a nice rally to finish out the week. Or at least on Thursday we did. Friday was a little bit flat, but anyway. But what we saw the major averages go out to new record highs on Thursday. We had commodities go on the U.S. dollar going lower. We also had oil prices start to move up, and in fact, yesterday crude oil prices kicked up over $60. Now that's mainly, part of that's because of a lower dollar, but it's also mainly on more growth prospects going forward if we indeed have a nice trade deal worked out. As far as the sectors go, we had technology was the main leader last week. That led the advance. We had good gains in financials, consumer discretionary, and energy. Also had a 4% spike in the Philadelphia Semiconductor Index. So if you were long some of those leveraged ETFs like the SOXL, I believe it was up almost 20% just last week alone. So some of those that are triple leveraged, you might want to look at some of these situations like this. And as far as weakness went, we did have some weakness in REITs last week. That was the weakest industry or sector. And we also had some problems with communication services, and that was mainly due to weakness in Facebook. If they had some different, Facebook was weak last week. As far as the technical condition of the market, it improved again last week. I think we've been up. That was the third consecutive week. We're up this week. This will make it 4 in a row for the S&P and the Nasdaq. Momentum looks strong in here. The 14-day RSI is positive. As of yesterday, though, the S&P short-term oscillator got it moved into overbought territory finally. Part of that has been just because of some of the new highs and new lows that's figured in there was not expanding, but they are now. There will probably be more overbought today. We'll be getting up close to where we could see some consolidation in the market. MACD, which measures the short-term trend of the market, it was crossing in the bullish ground for most of the different indexes on Friday, which means that we should see some kind of drift higher, which we're seeing this week. Most of the market sectors last week did punch new highs, confirming the market's move. The only sectors that I saw on Friday that were rated a void were REITs and utilities. And like I said, utilities are actually starting to show some strength in here, so a little bit surprising. But I guess you can hold on to them mainly because of the yield. Breadth has been improving. We had a nice move in the NYSE and the NASDAQ advanced decline lines. The NYSE punched several new highs last week, and we had some real nice expansion Thursday and Friday in the number of new 52-week highs, which you want to see. That shows broader participation in the market rally. On Thursday, we had on the NASDAQ 326 new highs. That was the largest number since last June, or June 2018, in fact. So that just shows some nice participation moving forward. And I think based on what we're looking at in the technical condition of the market, I think we can still work our way a little bit higher here as we start to see the benefits of a Santa rally. Plus, we're going to see more of the retirement funds and pension funds bring money in at the end of the year. That's one of the reasons why we have a Santa rally, and which I think we can probably see the market nudge higher or inch higher here going into the end of the year.
Thanks, David. Let's move on to the market recap and look at some of these internal breadth indicators.
Okay, we'll go down here. Let's look at the advanced decline lines here. Look at the New York breaking out the new highs here. That's strong. You want to see more stocks being accumulated. You're going up and down. And also in the NASDAQ, we're getting up to where we were at the beginning of October. I think yesterday was, I think we had yesterday. I think yesterday was even more. I think we had 350 or something like that since the NASDAQ. So, the AD lines are moving up. The new highs, new lows. You can see that big jump in there. Look at the new highs on the NASDAQ yesterday. We got up to 343 or something like that. We're up strong again today. That just is a confirming measure of that the new highs are being confirmed by the action in the internal breadth of the market. And also we had volume pickup yesterday. It was heavier than normal. I did not check the volume today. It may not be quite as high, but yesterday, as people came in off the sidelines due to the trade deal, and no surprises over the weekend. I'd written over the weekend that as long as we didn't get any tweets out of the White House that any surprises, that we would probably have a nice day yesterday, as they just want to be cautious. They've been whipsawed a little bit on these trade deals, so we didn't get any surprises over the weekend, and we did see a lot of money come in the new buying over the weekend.
So we've been seeing the market hit some new highs recently. Do you think this is a shorter-term trend, or is this Santa rally going to run a bit longer? We've also gotten a few questions about where we can find some good ideas going forward with the Phase 1 trade deal.
All right, I do think we're going to rally through the end of the year. Again, this is we have a seasonality trade, which we generally will see a buying going into the end of the year. A lot of times there's more of a emphasis on some of the stocks. You do get some of the stocks that have underperformed. You'll get some losses taken in those. The same aspect, you get some people that are going to try to buy those stocks that were beaten down that you see going down this week. They'll start to buy them next week because they think they're oversold because people took tax losses. So that's a place you can look into that. But as far as our market posture has been neutral to long. It's been neutral, but I've been saying in the writings daily and weekly that I do think the market's going to work higher from here. One of those reasons let's go over to the charts for a minute. And at this part, I want to discuss the CTI, which we've had a couple questions on that. The CTI is not an exact science, and what it does, it measures certain cycles that were identified in the market over the past. Over like 40 days, over 40 weeks, over 18 months, this type of thing, 54 weeks. And anyway, what we did this year, going back here in August, I pegged this here on August 8th, basically as the low, that week of trading as the low for a cycle, because we had such a long cycle back here from last year that lasted all the way into June. It went much longer than normally. Normally we're looking for something like a 18-week cycle, and it went, I think, something like 20 something. Then we thought that perhaps we would have, if you have a long cycle, then you're followed up with a shorter cycle. And so at around 11 weeks after this bottom, I thought that this was probably where we would start to, may have been the bottom. And then as we started to move higher over here, I went ahead and said, okay, this is where our CTI was going to be set. Now, in reality, If you look over here at the 1st of October, where we made another low, this would have actually been 18 weeks where it probably should have been pegged as the low. Now, we'd have missed out on this part of the rally because we'd have been neutral to avoid it here, but we would have gone long again right here, and we'd be riding this out. So this is the low as it looks like as it is. We're going to be actually would be long, and I don't see any deterioration in the cycles now until in the January. However, at this stage, that sell cycle will be like what we have this time, where we're neutral. I believe that we'll be neutral. So I believe you may have a slower run in January, but I still think you're going to be fine. And then we go at the end of January, we go to another buy cycle, and that goes out. I've examined it out through into March. So I think it's actually going to be a fairly good early part of the year. Bank of America today actually came out, and they said they could see a melt up in the indexes after the first of the year. Part of that, I think, is due to the fact that we've just had 4 quarters of negative earnings growth, and the market's hitting new highs. So the market's looking forward on a trade deal. We should return to positive earnings growth here in the first quarter, and that should help hold the market up, going forward. So I don't see any reason to be anxious to sell in here. Of course, we're going to have a lot of volatility end of the year with some of these big swings, and of course the White House always adds to the volatility. But the underlying strength and internal breadth should keep us long in this market. With periods of overbought and a little bit. Sometimes people are going to buy the dips, however, going forward. Now, the second part of that question, surprising what you can find, like something. A lot of people wonder, okay, well, if we get a phase 1 trade deal, the market's going to go up. Well, there's also certain segments of the market or categories of the market that you could look at that are also going to be affected by Chinese growth. Now, one of these things you can look at is if you go into into ETFs, and let's take a look over the last let's look over just over 1 week. You'll see they're talking about buying more agricultural products from us. Okay, well, for the last week, what's been one of the biggest, the best performing ETF groups? Agriculture commodity. Okay, so that means we know they're going to be buying more pork. We know the Chinese are going to be buying more soybeans. That would be an ETF in that section there that you could find some ideas to trade. Alternative energy is also one that we're seeing a nice move in last week. Part of that is because of the solar panels. Solar panels that were coming over from China had a lot of tariffs on them. This will open that segment of the market where we're not going to be getting big tariffs on that type of thing. Of course, internet and technology is going to outperform. Healthcare right now is outperforming. That doesn't really have anything to do with the Chinese trade deal, but healthcare has been very strong in here, and of course, technology. Now, another thing that I saw in some of these ETF groups, I looked at BJK as one. It's a gaming ETF. Of course, you had a couple of years ago, you had people were talking about the Wynn Resorts and some of these other different gaming companies and casino stocks were going to go into Macau, and that would be a big boost for their earnings and revenues. And then that's kind of died off the last year. Well, if you go, okay, here's another place you go in here in the industry groups, and if we see what's strong in here, we can go to this, or we can even look at the top last 1 week percent on these, and you'll see, okay, semiconductors and related are big. Here's lodging. I think casinos are in that group. Lodging and casinos, I think, is in there. But these are places that you wouldn't think, you don't think, you think outside the box a little bit, and you'll see these kind of areas that are going to outperform because of a trade deal. Energy, because you're seeing gas, crude oil, and gas go up in prices. That's not, we still have an oversupply. However, people are thinking, okay, growth prospects improve because of the bilateral trade deal. That's going to cause more usage for gasoline and for oil. So that should you see those stocks move up. Valero, VLO has gone up. You're seeing some of the refiners will start to be moving up in here. So if you look at some of these industry groups, and you want to see why, take a look what's outperforming, and then try to dig down a little bit more and say why is that group outperforming in here. And if you start to look that way a little bit, then you can see that'll be some ideas where you can go in and find some other places that you may not be talking about yet on TV, but that'll be a place where you can find on our site some good ideas going forward.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like answered on the next Tuesday Tech Talk, you can email it in to support@marketedge.com or ask one of our live chat representatives to pass your question on to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.
Check.